Okay, so now that we talked about the assumptions, let's talk about the basic principles of generally accepted accounting principles. Okay, so the first one's going to be historical cost. Okay, what does this mean? This means that this principle says that when you acquire either assets or anything that, you know, fixed assets, other assets, whatever it is, right? You have to record it at historical cost value, meaning the day that you purchased it is going to be what you purchased, and you're going to keep it in your records, and that's the value it's going to hold for the entire time that you have that asset for. Okay, we call this the historical cost. Okay, meaning that's what you bought it in the past, so that's what it's worth in your records. Okay, now the only exception to this rule is going to be your securities and inventory, right? We'll talk about what inventory does, but eventually when you sell things like electronics, right? Oftentimes, because of the new advancements of technology and things like that, you're gonna notice that your $800 laptop that you're trying, or $800 laptop that you're trying to sell on the market, if it's been there for 3 years, you can't expect to sell it for $800, right? It's gonna lose value over time because, again, with the advancements of technology, there's always going to be a newer, better product out there that's more available, right? Especially with laptops, right? Every laptop that you get, that you see that are going through, right? Better processors, better cameras, better, holding space of memory, better processor, right? There's something better and better and better with technology. So someone would definitely buy something that's way more newer than they were invest in an older product, right? So that's going to be an exception to that rule, is that inventory does lose its value over time due to the advancements of technology. Other things too is going to be securities. When you buy a bank bond, if it's $100 now, 10 years later, you hope it to be at least $200 later, right? So that's going to be an exception to this rule, is that it's not going to hold its value. It's the securities and the inventory are not going to hold its value over time. But when we record our fixed assets, we have to use the historical cost principle here to ensure that we have value added to the company, right? Because most of our fixed assets eventually become our investments. It's what we invest into our own company, right? So a great example is if you were to purchase a machine for $50,000, you are going to record it in your books the day that you purchased it at historical book value, which is going to be $50,000, right? Even if you are willing or going to sell it for a higher price, okay, you're going to keep it in your books as $50,000. Okay, now here's the thing. Even if it's fast forward 5 years later, it's still going to be recorded at $50,000. The only time you actually change the value of it is if and when you choose to dispose the asset. Okay, meaning get rid of it off your books or sell it to someone else. Okay, and we do have that section, and it will be for chapter 11. Okay, we'll talk about depreciation, purchasing fixed assets, and what you do when you need to dispose them. Okay, but that's going to be something that you have to keep in mind, is that anything that you buy for the business, whether it's a fixed asset, other asset, it's going to hold its value the day that you purchased it and will not change its value until you choose to sell it, get rid of it, dispose it. Okay? So again, think of it like, I want to say this, but you have to be very careful too. Do not compare and contrast accounting to property management, because property management is a whole nother ball of difference here. Okay, in this case, right, when we understand equity, right, we understand when we buy our home at $100,000, eventually over time that house, it gains value over time, right? It becomes $400,000 after 10 years, right? And then it becomes $800,000 again, 30 years later, right? The house is increasing value over time, and it generates equity. And we record that in our in property management terms as that house has value, even if you choose to sell it or not. In accounting, you cannot do that, because the purpose of this is, can you add invisible money? Is that something that you can do in a business? Can you generate money out of thin air? No, you can't. So that's the huge thing that I have to also warn you about is, do not mistaken accounting and confuse it with and compare it to property management, because they are two separate different ball games here. Okay? So one of them will recognize that your house has gotten to value, but in this case, I'm buying a fixed asset. It will stay $50,000 until I choose to sell it, get rid of it, or dispose it, right? Where property management, you automatically gain that equity no matter what given point in time, whether you keep your home or whether you sell your home or not, right? Okay. Second one is going to be the realization / revenue recognition. So it's mostly known as revenue recognition. But what this does is you're going to be recognizing your revenues when it is realized. Okay, so again, this goes along the lines with the accrual type of accounting, where even though we sold something, whether we received money or not, the idea is that you earned the sale. So you earned that revenue because a transaction was made, right? You earned the fact that you sold and got rid of your inventory. So that's what revenue recognition does, is that if, for example, when you're recording a sale of an item, right, at time of sale, whether you received money or not, that's important. The fact that you sold the product, it's done, it's sold, you immediately recognize that you earned that revenue, okay? All right, we'll talk about accrual in a minute. But that's what this means, is that no matter whether you receive the money or not, if you intentionally sold the product and it leaves your store, you immediately recognize it. Okay? And this also goes hand in hand with the matching principle, okay? Where all expenses that are associated to generate that sale is going to be matched. So for instance, right, when we talk about selling our product, what is the equal and opposite expense to it? It's going to be the cost of goods sold. So that's exactly how we have to match our revenues to our expenses, right? Even though we purchased it at a lower price, what also is included in the price that you sold your product with? It also included a profit percentage, right? So that's what you're going to do, is when you generate a sale, you're going to match the equal and opposite expense to equal out the reasons of why you actually had that sale. So that's why when you sell a product, right, usually when you're doing inventory, in order to get rid of your inventory, right, you have to calculate the cost that it took you to sold the item in the first place. So that's an example right there, where if you recognize that you sold a product, what is the equal matching expense that you have to match it with? Okay. And then last but not least, number 4 is adequate disclosure, because again, when we look at all of our transactions, there are too much information about a particular transaction that we have to record. Now, in this case, instead of cluttering your journal with all the details, so again, we can write a paragraph in your journal, but you shouldn't be doing that, right? The journal is only meant to record your transactions between your accounts. You shouldn't be cluttering it with so much detail or pertinent information, even though it is pertinent to the transaction, right? It's necessary. It builds the reasoning why you have this transaction. So an example for this is, remember when we talked about earlier for the monetary measurement, right? If we have 20 employees and they are either salary or waged earnings, right? we have to find a space in the financial statements. So we normally call that the notes to the financial statements. That's where you're going to report the number of employees, right? Especially when you have to deal with salaries versus wages, right? Because in my journal, I can say I spent $50,000 on salaries and wages expense. But what are you leaving out there? How many of them are salary? How many of them are wages? Who are getting the salary? Why are they getting salary versus the other employees are getting wages? That's where you're going to be putting all that information to the notes to the financial statement. And we call that adequate disclosure, because this is definitely pertinent information, right? Why are you spending $50,000 on paying for salaries and wages? Well, I have to pay my president $2,000. I have to pay this guy $2,000. And then I have to pay all of my hourly wage workers, maybe $200 here and there, or whatever, $800 for the week, right? So that's where you disclose that information, okay? So any questions in regards to basic principles?
No.
Not at this time.
Okay. All right, so the last four is going to be constraints and conventions, okay? Now, the first one is going to be your materiality convention, okay? Now, this tells you that you only record a transaction if it has some kind of significant value or some significant change or effect to your business, okay? If it's not significant, or we call it insignificant, you don't need to record it. It can be ignored, right? So for example, right, when you're purchasing an asset, right, let's say you want to buy a $5 trash can, okay? Now, for this example, right, are you going to record it as an asset, or are you going to record it as an expense? Now, what is $5 going to do for your assets? Is it going to benefit? Is it going to drastically change your numbers? Is it going to affect your business in any way if you record a simple $5 trash can as something that you own for the office? In that case, you're better off writing that as an expense, right? That you purchased it for the office and it's an expense, as in you bought it for this month and that's it. That's all you have to record it for this month. Okay? Compared to buying a $10,000 machine, okay, to help you produce the products or whatever it is that is needed for the business, right? Compare yourself. A $10,000 asset is a huge amount. That's going to definitely affect your total assets, right? So that's what it means right here is, what are you going to do? And that's the materiality constraints here, is because, is it material enough that it will cause some kind of significant effect to your business? So again, comparing a $5 trash can, was that something that you want to put as a fixed asset? Or is that something that you can do as a mere minor expense? Versus a $10,000 machine, you should definitely not have that as an expense. That's definitely for sure an asset that you definitely want to record. Okay. Number 2 is going to be the cost-benefit convention. Okay, so this is where we're going to have a little managerial come into play here, where based off of the benefits, right, of providing specific information, right, what are we doing is we are going to compare. Is it going to benefit you for the amount of cost it's going to spend for you, right? That's what you're doing. You're comparing an alternative, and is that alternative going to weigh out against the benefits and the cost that it takes you? So again, is it going to benefit you to provide your financial statements? Okay, and weighing out the costs that it cost you. So a great example of this is when you have two alternatives. Okay, let's say for instance you are a t-shirt company, right? Option one is you can either produce the shirts in the United States, but of course, and the cost of it's going to be very high. But the benefit is that you get a 24-hour turnover rate, meaning you can go pick up those shirts the next day and sell it as soon as you put it in your inventory, right? That's a benefit, but the cost is extremely high. Or option number two, would it benefit you to go ahead and have it made overseas, right? We call outsourcing it. Get the product done overseas, right? And have it shipped in. The cost of it is low, but the difference is it takes anywhere from a week to 2 weeks to have turnover, ship it through, and get it to your store. So let's weigh out the options here, and that's what the cost benefit does, is that because this is going to again affect your financial statements, right? It's going to affect that. Did you spend all this money to get the inventory that you need? Well, what's the benefit there? Okay, so that's what you're weighing out. Is you have a couple alternatives for the cost that it is priced at. Is it going to benefit you, and how does it benefit you? So one of them you can start selling as soon as possible, but the cost is higher. Or the other one is you're going to have to wait 2 weeks before you can sell your product, but the cost is significantly lower. Okay? So that's the cost benefit idea there. And number three, this is where they are linked to each other, is that it's going to be the conservatism convention. Okay? This is going to be where out of the alternatives, which one is going to least likely overstate your assets? Okay? So again, out of the alternatives, which cost benefit is going to least likely overstate your assets? So what does that mean? Well, in this example here, right, I did a different example. If you were to split numbers, okay, for instance, if you had a cost of 1.855, right? What are you gonna do? Are you gonna round up, or are you gonna round down? Now in this case, you have half a penny. So what are you gonna do? Are you gonna benefit yourself by giving you the less cost, or are you gonna benefit yourself? No, I mean not yourself, but benefit the government, right? Because they're going to be, taking the money from you. Would it benefit you to round up? You would lose profits, but at the end of the day, it least likely to overstate your assets, right? You don't have too much money in your assets. That's the goal, is making that executive decision. So again, if you purchase those shirts, right, and it costs you $1.85.5, right, or whatever it is, right, you have a split penny going on. Is it going to benefit you? Okay, and we're going to compare, right, using the conservation. What would least likely overstate my assets? If I lower my cost of what I sold, right, it will benefit me because I get a better profit. But that's not the goal. You're supposed to benefit yourself to least likely overstate your assets. So you would increase it or round up, so then the amount of inventory that you have is less when you sell it. Okay, so again, it's a tricky one, but this is more or so for managerial accounting. Okay, so out of those decisions, that's what you're going to be doing. So again, for instance, sales tax, right? Sales tax is 8.375%. You're going to get a bunch of different numbers at the end of the day. What is the rule of thumb there? You round up because it will benefit the government, right? But it will least likely to overstate your assets because again, you are not going to be, you're gonna collect less money. Okay, so that's that idea there. Okay, and the last one is going to be industry practices. So I did touch upon industry earlier today. What is an industry? An industry is basically what kind of area of business that you fall under. So for instance, right, I said that there's a restaurant industry, there's the fashion industry, the makeup and beauty industry, okay? They all provide a product or service in a particular area, okay? So in this case, right, with the industry practices, what we want to do is that when a certain business, right, in the same industry as you, adopt some kind of principle or some kind of custom, right? As someone who's in the same industry, you tend to also follow them in that same industry. Meaning, if this coffee shop is doing this, then you would tend to gear towards and gravitate to do exactly what they're doing because you guys are all in the same industry. You guys are providing the same products and services. So therefore, if one company is doing something, you're more likely to also conform and do the same thing. And we call that industry practices. So a great example is if you are a small local coffee shop, you are most likely to conform and compare yourself to other coffee shops such as Starbucks, Dietrich's Coffee, Dutch Bros, Dunkin' Donuts, okay, to see what they're doing, and if they're doing something better, you would kind of follow in the same format as them, and so on and so forth. Okay? Any questions in regards to the constraints and the conventions?
No.
Okay. Norman, no questions?
Not at this time.
Okay, so now for this section here in GAP. Now I did say this earlier, is that these ones are more for managerial cost accounting type of rules, right? You're not going to have the option to have, for this class at least, you're not going to have the option where you're weighing against the cost of doing something and so on and so forth, and you're not going to use the conservation or compare your books to someone else, okay? So in this case, for this class, you do need to know what they are, but I'm not going to test you on these 4 particular constraints and conventions because we're doing financial accounting. These are not things that you're going to be utilizing for financial accounting. Again, this is more for managerial cost accounting. Again, where you're trying to produce a product and you're weighing out the cost to it comparing to producing the product. So again, I'm not going to test you on these 4 items, but you do need to at least know what they are because it's part of the rules of GAAP. Okay? So now let's go ahead and talk about cash basis versus accrual basis, okay? So what is cash versus accrual? Now, cash basis, okay, so here's what the rule is. You're only going to record transactions based on whether you received cash, okay? So for instance, you're going to only record income when cash is received, right? And you are only going to record your expenses when cash is readily available for you to spend, okay? So again, most mom and pop shops, especially startup companies, right? They have to run on a cash basis because again, the ability to allow your customers to owe you on money or you owing other people money can be a very, very fine line, right? Especially when you are a small mom and pop business and you need to kind of get your business going, right? You need to know how much money is coming into your business versus how much money you need to be spending on your business. So in this case, typically some mom and pop shops or startup companies would start off as a cash basis and eventually will adapt or adopt to an accrual type of basis. So again, the reason here is that means everything is strictly cash only. You sell a product, you only accept cash. You're gonna pay a vendor, you can only pay for what the cash that you have in your bank account. Okay? That's cash basis. Okay? Accrual basis acts very similarly, but at the same time very differently. First thing is that even though we're going to record a transaction, okay, whether or not we received cash. Okay, so for instance, income. We record income when it is earned. Okay, whether we received cash for it or whether we had it owed on an account. So again, remember, what does owing on an account mean? It means that's invisible money that's being being owed to you, right? You're still selling the product to this customer even though they said I'll pay you back later. So they're writing you an IOU, right? And in this case, even though you did sell the product to them, you earned it. You sold the product to them. So therefore, you're going to record that you got that revenue, even though you didn't receive any penny for it. That is accrual basis. So this is where accounts receivable and accounts payable is going to come into factor here. And most businesses right now are using the accrual basis because what do we have? We have credit cards. We have the ability to create an account and have someone borrow money from us to buy the products and services from us. We also can create our own accounts with our vendors, right? Saying, oh, can I buy this now? I'll pay you in 30 days. That is where accrual basis comes into play. So again, you're also going to record your expenses. You're going to record your expenses when it has incurred. So once the job has been done and completed and you receive a bill, that is where you're going to record your expenses, whether you paid or not. It's incurred. The job has been done. That's when you're going to record that your expense has been completed. So that's the huge difference between cash and accrual. Even though if you are on the accrual basis and you do receive cash for a transaction, you'll record it no matter what. So that's why I meant they are similar, but the only difference is this one has the capability to record things that are being owed to you as well. Okay? But for cash basis, if they don't pay you, nope, sorry, I'm not gonna sell the product to you, or I'm not going to record that sale. Okay? So that's the huge difference there. All right, so let's go ahead and take a look at an example. So this kind of makes more sense. All right, so here's an example. Okay, you are a construction company. Okay, you're a construction worker, and of course, your task is to build an office building. Okay, for $50,000. Okay, and of course, the construction is going to start as soon as January 1st, and it is scheduled to be completed by April 30th. Okay, so you have 4 months to build the building. Okay, and if the company decides to pay you $50,000 on January 1st, okay, how would you record this transaction? So if you're on a cash basis, right, you received cash. Even though you haven't completed the job yet, you still received the cash. So what you're going to do is you're going to record that you received the cash for $50,000 and that the service, even though you haven't completed it yet, you still received cash. So the service will be completed, so you charged it as a service, right? And then again, in April, how are you going to record it? Well, you already received the cash. So no necessary recording needs necessary because you already received the cash for the service. So that's cash basis, right? So in April, you don't care. Now, what about accrual basis? Okay, it's January. You're still going to record that you were given cash, but here you're going to recognize an unearned revenue or unearned service. you haven't completed the service yet. So therefore, you owe the service. So in this case, that's what you're going to record, right? And then, right, you don't record it until you actually complete the job. That was the rule. Here in April, you finally completed the project. Then you're going to recognize that you completed the service by crediting it. So again, service is revenue. Revenues are increased by credits. Okay, so that's how you have to differentiate the two. One of them is you're going to record it, but it's a liability, not a sale. Okay? You're recording as a liability because you owe the service. You haven't completed it yet. Then, once you completed the job, then you're going to recognize that you no longer owe the service and that you finally earned the service. Okay? So that's the huge difference here. Any questions?
No.
Now let's do another scenario. You have the same exact scenario where you have to build a building between January and April, right? But this time, what if the company decides to pay you $50,000 at the end of the project on April 30th? How would you record it this time? Well, same thing here, right? January. Well, you haven't received the cash yet. So, you're not going to record that the service was done. But on April, because you received the cash in April, then you recognize the service has been completed. Okay? Where an accrual basis, okay, January, same thing. You're not going to record anything because the service hasn't been completed yet. So you can't recognize it no matter what. Until April, you're going to record it even though, yes, you received cash for it. You're going to record that you earned the sale. So that's the huge difference there is it has to be when the job has been completed is when you're going to recognize it under an accrual basis. Cash basis, you record it as soon as you receive the money, whatever it is, whether you completed the service or not. The idea is that you receive the cash. Okay? And that concludes today's lesson on chapter 4, okay? So here we talked about the accounting cycle, right? So for this class, I just need you to recognize what they are. The order right now doesn't matter, just as long as I can identify what they are, okay? We talked about what the accounting period does, right? The accounting period is when you schedule to complete the accounting cycle, right? And it can be broken down to daily, weekly, monthly, quarterly, or whatever in terms of means that you want to keep track of your business. But at the end of the day, you have to do an annual report at the end of the year. Okay? And you can choose either or calendar or fiscal year for the purpose of filing your taxes. And of course, we talked about the characteristics of financial statements, right? These are what the financial statements produce so that your internal and your external users can trust the financial statements. Okay? And then we talked about generally accepted accounting principles, GAAP for short. Now, I don't have a mnemonic device to kind of memorize this, but think of GAAP as learning your ABCs, right? You're learning your assumptions, your basic principles, and your constraints and conventions, okay? So A, B, and C, okay? So each one has four sections under it, okay? So again, each principle, so there's a total of 12 principles right now, and each one are designated in each one. Again, I'm only going to test you on knowing the ins and outs of the definitions and how to apply them for your assumptions and for your basic principles. Your constraints and your concerns, you just need to know what they are and that they exist under GAAP. Okay? I don't need you to know the ins and outs of them. I just need you to recognize that they are constraints and conventions. Okay? But for the first 8, I need you to know the ins and outs, how to apply them, what's the definition, and and how to apply them. Okay, if I give you a scenario, can you identify what this is? And then, of course, we talked about cash versus accrual basis. So, again, you only recognize things when cash is received or when cash is spent. On accrual basis, you only record when it is earned or when the job is done. Okay? Whether or not you received cash or not. Okay, so let's go ahead and dive right into the exercise here. Okay, so chapter 4 exercise. Number 1, what is the accounting cycle?
It is the methodical set of rules to ensure accuracy and conformity of financial statements.
Good. Set of rules to ensure accuracy. Okay, good. What are 4 characteristics of financial statements?
Reliable, relevant, consistent, comparable.
Good. Number 3, okay, what are the 10 steps of the accounting cycle?
Collect source documents,
Good. What else?
analyze and sort data,
Good.
record transaction in general journal,
Mm-hmm.
post entries to general ledger, prepare unadjusted trial balance, enter adjustment entries, prepare adjusted trial balance, create financial statements, closing books,
And last one?
post closing trial balance.
Good. Okay. Number 4, okay, what are the difference between calendar and fiscal year?
Calendar year is 12 consecutive months.
Starting on?
January 1st and ends December 31st.
Good. And then? Fiscal?
Fiscal year, any consecutive 12 months starting on the 1st of the month
Mm-hmm.
and ends the 30th or the 31st of the 12th month.
Good. First on first month and ends on the last day of the 12th month. Good. Number 5, what are examples of an accounting period?
Daily.
Weekly,
Mm-hmm. You could do financial, yep.
monthly,
That's the most common one, monthly.
quarterly,
Good. All right. Number 4. I'm sorry, number 6. What does GAP mean? Or what does GAP stand for?
general accepted accounting principles.
Good. Generally accepted accounting principles. Good. Number 7. What are the 4 assumptions under GAP?
Business or economic entity,
Okay.
going concerns,
Okay.
monetary,
And
and accounting period.
good. Number 8. What are the 4 basic principles?
Historical cost principle,
Mm-hmm.
realization principle, matching principle, and full disclosure principle.
Yeah,
Adequate disclosure principle.
mm-hmm. Adequate disclosure. Good. And then what are the 4 constraints and conventions?
Materiality,
Mm-hmm. Materiality.
cost benefit, conservatism, industry practice.
So number 10, under cash basis and of accounting, revenues are recognized when blank is received, and expenses are paid when blank is available to spend.
Cash,
Cash.
Cash,
Cash and
what's the other tax?
cash,
Okay.
right. Everything's cash when it comes to cash basis. Cash, 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 right? Okay, under accrual basis of accounting, revenues are recorded when blank, okay, and expenses are recognized when blank.
When transactions occur,
Okay, so incurred would be expenses, right? Because it has to be when it's completed. But when do you record revenue?
when you earn it,
When you earn it, correct. Okay. All right, so the next couple questions are going to be testing your knowledge on the rules of GAP here. So, number 12, under the rules of GAP, okay, which rule states that you must separate transactions from personal and business? I gave you an example of this one. Was having a separate business bank account versus your personal bank account.
Business or economic entity?
Correct. Business or economic entity. Okay. Number 13, under the rules of GAAP, under GAAP, which rule states that when assets, states where that assets that must be recorded at original price or fair market value? Which rule states that one?
Monetary.
Non-monetary. When okay, so this one's when assets, okay, when you acquire them, right? They must be at original price or fair market value.
Counting period.
That's not an okay, yes.
Monetary?
Not monetary. Now I could see how you could mistake this one for monetary. Now, in this case, right? If it was monetary, this question would be, well, then assets should be in terms of dollar value, right? It should be recorded as a value. In this case, I'm saying it's being recorded at original cost, the fair market value.
So going concern.
Not that one. Principal.
Business or economic entity.
This isn't where we're making a decision between personal and business.
Okay. So business or economic entity.
No. So, okay, so we're not on assumptions. Try a principle. What principle states that when you purchase or acquire any assets, it has to be recorded in terms of original cost or fair market value? What do we call that? So if I buy a $50,000 machine, I have to record it in my books as $50,000, even if I plan to sell it for $75,000. What was that?
Historical cost.
Historical cost. Yeah, and this one this is this one. Okay. Number 14, under GAAP, which rule states that when recording a transaction, okay, it must be in terms of value or dollar amounts, right? And it cannot be in terms of quantity.
That's monetary.
This one's monetary, yes. Now, in this case, I don't need you to be very specific. I just need you to know the general that it's monetary, right? I don't need you to tell me that this is monetary measurement because they tell you to record in terms of value, right? Monetary unit says you need to choose some kind of currency, right? And then stable currency would be what kind of currency would you use that reflects your money, right? In this case, I don't need you to know the specific ones. I just need you to identify that it's monetary assumption. That's it. Okay. Number 15. Okay. Under GAAP, okay, which rule states that when you have extra information that is pertaining a transaction, okay, if for example, number of employees, wages and salaries, cost of inventory, you must record it in the notes to the financial statements. Adequate disclosure. Good. All right, last question of the day. Under GAAP, which rule states that all revenues must be equal to all expenses?
Matching.
Yes, matching principle is correct. Okay. All right, good job, guys. So again, this is chapter 4. Now, next week, I'm going to be uploading material for chapter 5.